I think the first thing to say is this depends on how you allocate the money. If you spend it on supporting your constrained sectors like, say, hospitality and tourism, they won't be able to respond because of the constraints of the virus, and you'll have a low impact on growth. Whereas if you invest in things like the green and digital transition, which aren't constrained sectors, then particularly in this situation where you've got a lot of spare capacity in the economy, you can have a very significant multiplier effect. So the key decision is how much you're willing to put towards investing in these unconstrained, sort of forward-looking sectors, as opposed to playing defensive and supporting the existing sectors. Obviously a very difficult political decision. But what we're saying is, if you have that political commitment to focus on investment in unconstrained sectors, then you can have a really nice high multiplier, say around 1. So you've got 5% of GDP over the lifetime of the recovery fund. That's the size of the fund. That will add 5 percentage points to EU growth. And when you look at the periphery, you've got 9% of GDP going into Italy, 13% of GDP going into Spain. You have an even more dramatic impact. So the potential is there for this larger impact. It's not our base case, of course, because we think there'll be political considerations, which means more will be spent on these more constrained sectors, which will have a lower growth multiplier. But we think the Commission lowballed the growth impact. They're quite sort of conservative economists. They picked a multiplier of 0.4,
right,
just 2.25% on growth, and we think that undersells the growth impact the recovery fund could have.